Yes, so we had done a computation of the goodwill, but I don't know what we are getting as the goodwill. So it was coming to a negative figure. So confirm whether you have the same figure in this case as the one I'm having to expect. As the one I'm having to expect. So what was the figure we were having to get? What was the figure we were having to get? What was the figure we were having to get for the goodwill? What was the figure we were having to get for the goodwill? So I think you should have gotten a figure of, we got a figure of negative 20,100. And of course, you said that will actually end up having to be recognized as, so we got in this case a gain. We got a gain on bargain, a gain on a purchase bargain, a gain on purchase bargain, again on purchase bargain over 20,100. So this is the figure we should be having. This is the figure we should be having as per our previous class. So I want us now in this case, we look at a number of computations there. Of note number two, of course, not number one. You are told at the date of acquisition, the fair value of S Limited's net assets approximated their carrying values with the exception of an item of plant and equipment, which had a fair value of 24 million above its carrying amounts. So it means in this case, there was an under declaration in terms of what depreciation. So we can do a working there. I don't know, it will be working one. So depreciation under charge. Depreciation under charge on revaluation of assets of the subsidiary. So in this case, the assets were revalued above by 24 million. So our shillings are in thousands. The assets were revalued by an amount of 24 million. So we'll have to, in this case, compute the depreciation on that. So of course, you are told the remaining economic useful life of the plant and equipment at the date of acquisition was 6 years. Depreciation is charged to the cost of sales. So the remaining useful life. So they revalued on when they acquired it. So the revaluation was on 1st of January 20. It is 2022, 1st of January 2022. So the depreciation in this case will likely be how much depreciation? So you're told in this case, the useful life is actually 6 years. You divide by 6 so that you can be able to get depreciation per annum. So in this case, you'll get a value of 4 million. I think it is 4 million. But remember, in this case, we are only having to consider this item or asset having to be in the business for 9 years because you are preparing financial statements. We are preparing financial statements as for year end 30th of September. I think it is 30th of September 2022. 30th of September 2022. So we have to only consider depreciation for 9 months. So we'll be able to multiply by 9 out of 12. 9 out of 12. So what do you get when you do that computation? What do you get when you do that computation? So 4 million multiplied by 9 out of 12. 4 million multiplied by 9 out of 12. Can see you're saying you can't be able to see. You can't be able to see. What about there? Is it any better? Is it any better? Can you be able to see there? Is it any better? Katha, I can see you're saying it's better. It is better. I wanted you to give me this depreciation for the 9 months. So that we can be able to know depreciation under charge. It is 3 million. It is actually 3 million. It is in this case how much? 3 million. So it is equals to 3 million. 3 million. So we said because it is an undercharge, we'll likely end up having to debit the cost of sales. Then we credit what? Property, plant, and equipment. So in this case, the entry here would be debit the cost of sales with 3 million. Then in this case, we credit the property, plant, and equipment with, in this case, how much? 3 million. So it means in this case, when you are preparing the income statement, we'll have to add this. It will increase the expenses because this was a depreciation undercharge after they revalued the assets. So that is what will end up having to happen with that one. Then we have the next note, note number 2. Sales from S Limited to H Limited in the post-acquisition period amounted to 30 million. So amounted to 30 million. So sales from S Limited to H Limited. So we can have the next working. I don't know, it will be working too. So S Limited to H Limited. In this case, amounted to 30 million. So you have in this case 30 million. 30 million. So this is an intercompany sale. So we have to eliminate. So we eliminate the intercompany sale. Eliminate the intercompany sale. We eliminate the intercompany sale by having to, in this case, debit the sales. We likely debit the sales. So debit the sales account by 30 million. And we credit, in this case, what? The cost of sales. The cost of sales by 30 million. So it means in this case, when we'll be coming up with the income statement, we less 30 million from the sales. We less also 30 million from what? From the cost of sales. So that is what you have to remember. Then still on the same item, S Limited reported a gross profit margin of 25% on these sales. H Limited inventory includes a fifth of these goods as at 30th of September 2022. As at 30th of September 2022. So in this case, there is what you're calling what? Unrealized profit on closing inventory. Unrealized profit on closing inventory. So we'll compute the unrealized profits. So unrealized profits, we'll compute the unrealized profits on closing inventory. Unrealized profit on closing inventory. So these items are fifth, they are still in the closing stock. So we have in this case a fifth multiplied by the 30 million. 30 million multiplied by the 30 million multiplied by the 30 million. So of course, in this case, already they have actually been able to give us the margin. They have already actually been able to give us the margin. So they're having to be told what the margin is, 25%. But in any case, you had actually been given a markup, you would have converted it into a margin. So in this case, it means we'll multiply by 25%. 25%. So if you had actually been given a markup, you'd have converted to a margin. So remember what we were having to say. But now they have already been able to give us the margin. So you don't actually convert. But ideally, in this case, you take the way it is because it is profit on the sales. They were having to say they sold them at 30,000. But our fifth are still in the closing inventory of H Limited. So what do you get when you do that? You get 1,500. I think you'll be able to get 1,500. 1,500. So how do you treat this one? How do you treat this one? Valerie, how do you treat this one? Unrealized profit on closing inventory. How do you treat unrealized profit on closing inventory? So you in this case do what? You debit the cost of sales, you add on the cost of sales, and in this case, you credit, in this case, what? Closing inventory. You credit, in this case, what? Closing, you less it from the closing inventory and you debit what? The cost of sales. So in this case, you'll end up having to say that we'll debit. So debit cost of sales, or basically what you mean, you add on it, then you credit the closing inventory, which means you less on it. You less on it, the 1,500. 100. So it means when you'll be coming up with the income statement, we have to remember this item, we have to add it on the cost of sales. This item, we have to add it on the cost of sales. So this item, we'll have to add it on the cost of sales. We'll have to add it on the cost of sales. So that is what will end up having to happen. So this one simply means we are adding. This one means we are having two less. So these ones will affect the income statement. This one will also affect the income statement. So we have to consider those items when you are coming up with the cost of sales in the income statement, because they're having to affect what? The cost of sales. We'll ideally add them there. We'll add them there. Then, so that is, of course, as per note number 2. H limited is to value the non-controlling interest. That is note number 3. H limited is to value the non-controlling interest at fair value at the date of acquisition. So for this purpose, S limited share price at acquisition date can be deemed to be representing the fair value of the shares held by the non-controlling interest. So of course, this one you had already utilized it when you are coming up with the fair value of non-controlling interest, when you are coming up with the goodwill. So hope you can be able to remember, not number 3, we had already utilized it. H limited investment income is dividend received from its investment in 40% owned associate, which it has held for several years. The associate reported a profit after tax of 30 million for the year ended 30th of September 2022. So we said in this case, if it is an associate, the holding company will take a portion. The holding company will take a portion of the profit after tax. So their significant control, their significant influence they have, you multiply by, in this case, what? The profit after tax. So it means in this case, as you'll be coming up with the income statement of this group, so the holding company should be able to take 40% of this profit after tax. So they'll include these associates in the consolidated statement of statement of income by having to consider what? The portion of the profit after tax. Remember, we said for associates, you don't consolidate. For associates, you don't consolidate. For associates, there's no consolidation you'll end up having to do. You don't add the assets of the holding company and the associate. You also don't add the expenses of the holding company and those ones of the associate. What ideally happens, for the income statement, you just take a portion of the profit after tax. So you don't consolidate associates. You don't consolidate associates. You just take, in this case, what? A portion of the profit after tax is what you'll be able to include as part of the profits of the group. So you don't end up having to add the expenses of the holding company and those ones of the associate, like what you do for a subsidiary. So ideally what happens, you take a portion of what? The profits after tax. So it means, since you've actually been told the profits after tax for this associate was 30 million, and of course the significant influence in this associate was 40%, we'll take 40% of these profits after tax, we'll be able to include them in the profits of the consolidated income statement, in the profits of the consolidated income statement, the profits of the consolidated income statement. So that is ideal in this case, what will likely end up having to happen regarding the profits after tax of the associate. The profits after tax of the associate. Then there is something we've actually been told there. H limited investment income is dividend received from its investment in a 40% owned associate. So of course, you said in this case, when you talk about a dividend having to be received from an associate, so it's like in this case, what's an intercompany balance that you have to, in this case, eliminate. So if you look at the income statement of H limited, there is investment income of 6 million. Hope you can be able to see it. There's an investment income of 6 million. An investment income of 6 million. 6 million. It means in this case, this investment income was received as a dividends. Was received as a dividends from what? From the associate. And if you can be able to recall very well, if you are very keen, you've been frequently revising what you've actually been saying, we've been able to say that in this case, whenever the associate pays the holding company, in this case, what? Dividends, is like an intercompany balance that you have to do what? Eliminate. So it means this particular investment income won't actually end up having to consider it when you'll be preparing the consolidated income statement, because it is like an intercompany balance. Ideally, it means it is the associate having to pay this one. It's just like this scenario here. This one is selling to this one. So it means they're having to claim from each other. So you eliminate those what balances. Like in this case, we talk about what? Trade receivables and trade payables. You eliminate those what? Balances. So it means in this case, this one won't end up having to appear as part of what? Our income items in the consolidated income statement. Assume you are told that maybe 50% of this was dividends from an associate. It means would have actually been able to only consider 50% of this 6 million when you are coming up with the consolidated income statement. But we've been told the entire of it was a dividends from the associate. Dividends received from the associate, we end up having to eliminate them whenever in this case we are coming up with what? The consolidated income statement. So that is ideally what in this case that particular first sentence is having to mean. H Limited investment income is dividend received from its investment in a 40% on associate, which it has held for several years. So we have to eliminate that what? Dividend income. It won't be part of what? Our income in the consolidated income statement. Then the second part, the associate reported a profit after tax of 30 million for the year ended 30th of September 2022. So it means when you are coming up with the profits of the group, we just take the 40% of the part of the associate. So that is basically, in this case, you do what? You include the associate in the consolidated what? Income statement. Then note number 5, as at 30th of September, no impairment on goodwill has been considered. Assume that profits and losses are accrued evenly throughout the year. So that is what they mean by that. In this case, it means we have to consider the expenses for the associate, not the associate, but the subsidiary. We have to consider 9 out of 12 because the year end is what? 30th of September. So they were accruing evenly. It's like in this case, they were accruing equally across the year. So it means when you are consolidating, in this case, the subsidiary, the expenses that have actually been indicated in the income statement, the incomes that have actually been indicated in the income statement, we have to, in this case, spread them. 9 out of 12, you multiply by them. 9 out of 12, you multiply by them. So like that. So that is what will likely end up having to happen there. So those are the items that in this case, you must actually be able to consider. So we talked about unrealized profits on closing inventory, depreciation undercharge on the evaluation of the assets, revaluation of the assets. Then we can do another one working. So we can do another one working. So we can do one more working. So I think it will be working 3. Working 3. Working 3. It will be working 3. So working 3. Working 3. I can see Ruth is asking, what do we do with the dividend? So we've said in this case, we eliminate. So we've said in this case, we eliminate. Hope you've understood there, Ruth. We eliminate that dividends. It is like an intercompany balance. We eliminate it. We eliminate it. And of course, you've been able to say it's like having to say the 6,000. You've been given 6,000. The investment income was 6. The investment income was 6. If you look at the income statement of, in this case, what? The holding company. Hope you can be able to see that 6 million. There's an investment income of 6 million. So this investment income was a dividend from the associate. Dividends from the associate, you eliminate them. So it means you will less 6 million. So it means in this case, what we'll report as the income in the consolidated income statement, it will be 0. It will be 0. It will be 0. And I said in this case, let's assume they said 50% of this investment income was a dividend from the associate. You would have lessened 50% of this. So you would have taken 50% of this. You remain with 3 million. So it means only 3 million is what you would have considered as what? As investment income in the consolidated income statement. But since the entire of it was from the associate, it's like having to say 6 million minus 6 million. So you remain with 0. So it means we won't report any investment income in the consolidated income statement. Dividends from the associate, you end up having to eliminate them. Is like an intercompany balance. It's like in this case, the holding company having to claim from a member of the group. The holding company having to claim from a member of the group. So is like in this case, trade receivables, trade payables. You eliminate the intercompany balances. So same case happens here. You eliminate that what? Dividends. You eliminate that dividends. So there is one of the items there. There's one of the items there. So non-controlling interest share in the profits. But of course, that one we can actually be able to look at it. Let me not do it now. So I'll do it when now in this case we get at that particular point. I'll do it when we get at that particular point. So non-controlling interest share in the profits. Non-controlling interest share in the profits. We'll do it when we get there. So now in this case, we compare the group consolidated income statements to the group consolidated income statement. Income statements, the group consolidated income statement for year end. For year end ended 30th of September 2022. 30th of September 2022. So we can put our shillings in thousands. We can put our shillings in thousands like that. So most obviously in this case, we are going to start with revenue. We start with the revenue. We can start with the revenue. So revenue. So revenue in this case, we have for the holding company, which was 546,000. 546,000. We have in this case for the subsidiary, it was 420,000. We multiply by what? 420,000 we multiply by what? 420,000 we multiply by? We multiply by what? 420,000 we multiply by 9 out of 12. Yes, we multiply by 9 out of 12. Then we do what? We less what? 546,000 plus 420,000 multiplied by 9 out of 12. Then we less 30. So we less 30. So there was an intercompany sale, 30,000. I think there's a 30,000 there that you'll have to less. You'll have to less. So I don't know what you get. What you get as the figure there? So in this case, you have the cost of sales. Cost of sales. So the cost of sales for the holding company, I think it is 378,000. So 378,000. So plus for the subsidiary, it is 300,000. 300,000. So 300,000. You multiply by 9 out of 12. You less the intercompany sale of 30. But now the other adjustments you've made. So the unrealized profit on the closing stock, I think it was 3 million. 3 million or 1,500. 3 million or 1,500. Unrealized profit on the closing stock, it was actually 1,500. 1,500. It was 1,500. Depreciation under charge, it was 3 million. So you added the 3 million. You added the 3 million. And of course, you should be able to get the figure there. So what is the figure for revenue? What is the figure for revenue? The figure for revenue is, I can see the first one there, you're saying it is 831,000. 831,000. Then the cost of sales. So the cost of sales, you've taken those ones of the holding company, those ones of the subsidiary, but the subsidiary only existed for 9 months. So we take 9 out of 12, but you have to consider elimination of what? Of the intercompany sale of 30. Depreciation under charge. Then of course, in this case, what? Unrealized profit on closing stock. So it comes to 577. So 577,000. So 577,000. So you can be able to get the difference so that in this case, you can be able to know what is the gross profit. What is the gross profit there? The gross profits, I think it will come to something like 4 what? So this is 0, 0, 0. This is 4. This is 5. 254. I think 254,000. 254,000. So that is the gross profits. Then, of course, after that, there's an investment income. Before investment income, we have in this case distribution costs. We have in this case distribution costs and administration expenses. So distribution costs and administration expenses. So distribution costs. Distribution costs, those ones of the holding company is actually in this case 36 million. 36 million. So we'll say in this case 36 million plus 9 out of 12 multiplied by those ones of the subsidiary, which are in this case 24 million. 24 million. Then you have in this case admin expenses, administration expenses. So those ones of the holding company, it is 42 million plus 9 out of 12 multiplied by those ones of the subsidiary, it is 28 million. So 28 million. So what do you get as the value of the distribution costs? The value of the distribution costs. What is the value of the distribution costs? The value of the distribution costs. 54. I can see you're saying 54. Is it 54? Yes, 54. 54. What about for admin expenses? Admin expenses, 63. I think it's 63. 63. So with that, you'll be able to get profit from operations. So profit from operations. So you can do the reduction so that you can get what is the profit from operations. Profit from operations. Profit from operations. It's coming to 137,000. 137,000. Then after that, we have investment income. We have said we won't actually be able to consider it. Investment income, we said in this case, we won't end up having to consider it. We won't end up having to consider it. So because now in this case, we'll say 6 million minus 6 million. So we'll have to, in this case, eliminate. So the cost of sales, it is 577,500. 577,500. So we can correct 577,500. Then it means this figure will change. That figure will change. That figure will change. It will be 253,500. So 253,500. You can correct 253,500. It means also this one will change. This one will change. 136,500. So we are lessing 500 throughout. 136,500. 136,500. 136,500. So I think that is what will happen. So we're having to say in this case for the investment income, we won't consider because you said it was a dividend from what? From an associate, which we will eliminate. So we can't end up having to put it there. We can't end up having to put it there. So we can in this case consider the finance cost. So the finance cost, we can in this case consider the finance cost. Finance cost. We can in this case consider the finance cost. The finance cost. The finance cost. The finance cost. We can in this case consider the finance cost. So of course the finance cost now in this case we are told for the holding company it is 4 million, sorry, and of course for the subsidiary it is exactly how much? 2 million, exactly 2 million. But if you look at in this case the introductory paragraph to that question, just look at the introductory paragraph to that question. The last sentence, I think in that introductory paragraph, the second last sentence, where you are told additionally H Limited will pay further consideration on 31st of December 2022 of shillings 11 per share acquired. H Limited cost of capital is 10% per annum, and the discount factor is actually 10% for 1 year. Exactly 10% for what? For 1 year. So in this case, we'll likely end up having to compute interest on the deferred amount. So we'll compute in this case interest on the deferred amount. Interest on the deferred amounts at 10%. It will likely be at 10%. So H limited cost of capital is 10% per annum. So this amount will likely be paid after a year. After a year. So after having been able, we need to be able to, in this case, consider what will be the cost they'll end up having to incur if they pay after what? After a year. So the interest on the deferred amount that is paid after a year. So of course, you had already determined the deferred amount. It was coming to how much? We had done the computation when we are coming up with the goodwill. It was coming to an amount of how much? Interest on the deferred amount was coming to an amount of how much? The deferred amount, actually, sorry, it was coming to 32 million. 32 million. It was 32 million. 32 million. So of course, now in this case, you are told the interest is actually what? At 10%. Is actually at 10%. It was actually in this case 32 million. So in this case, it will be 32 million multiplied by 10%. But remember, this interest won't actually be for the entire year. So you have to multiply by 9 out of 12. Because in this case, we're only having to count up to September. But of course, the amount will be paid after a year. But of course, now in this case, there's that what? The cost of raising that capital. There's that interest on raising of this particular amount to pay after a year. So they will incur that interest. And of course, it will be 32 million multiplied by 10% by 9 out of 12. You'll get how much in this case? You'll get a figure of, is it 2,400? 2,400. So 2,400,000. 2,400,000. And of course, this having to be an interest, it will be part of the finance cost here. So you'll have to add it here. You'll have to add it here. So it means in this case, for the finance cost, we'll be able to take. So for the holding company, it is actually in this case 4 million. It is actually in this case 4 million plus that one of the subsidiary, which is actually in this case 2 million, which is actually 2 million. But you have to multiply by 9 out of 12. Then we add that one, which is actually 2,400. So the interest on the deferred amount to be paid after a year. The interest on the deferred amount to be paid after a year. So what are you having to get when you do the computation? What do you get in this case when you do the computation there? So for the finance cost, you get 7.9. You get in this case 7.9 million. So 7.9 million. 7.9 million. But there's something in this case, maybe before you put this one, there's another entry you're supposed to make here. Remember, there was in this case what? A gain on purchase. A gain on purchase of what? Of the subsidiary. You can be able to put it here. So we need to consider the incomes first before looking at the expenses. So of course, in this case, we can be able to put it here. So just put it here. The gain on purchase bargain. So gain on purchase bargain. Gain on purchase bargain. Gain on purchase bargain is what we got when we were computing the goodwill. So what they were able to get as a benefit, it was actually 2,100. It was actually 2,100. Then in this case, you can now in this case consider the finance costs. Finance cost, which in this case you've been able to say you can be able to compute it. You take the 4 million plus 9 out of 12, multiply in this case by that amount of the subsidiary, which is actually 2 million. So 2 million. Then we add in this case that one, 2.4 million. So get in this case 7 million. So the finance cost will likely end up having to deduct. So remember, this gain on purchase bargain is what we got in this case when we were computing the goodwill. So it was a negative. And of course, I told you in this case, it will appear here as part of the incomes that will arise on consolidation, as part of the incomes that will arise on consolidation. Then, so of course, you have the gain on purchase. We have in this case finance cost. We have in this case finance cost. I think those are the only ones. Those are the only ones. So in this case, what do you get as the profit? What do you get as the profit before tax? The profits before tax. It says get the profit before tax. Profit before tax. The profit before tax. 148,700. You get 148,700. So 148,700. You get 148,700. Okay. 148,700. 148,700. Is there income tax? You can check whether there is income tax. Income tax, we have in this case income tax expense of 30 and 24. So you can list in this case the income tax expense. Income tax expense. I don't know whether you're able to see there. You can't be able to see there. You can't be able to see there. So we have in this case income tax expense. Income tax expense. So we'll take in this case that one of the holding company, which is in this case of 30 million. So you have in this case 30 million multiplied by 9 out of 12. That one of the subsidiary, which is in this case it is 24 million. It is 24 million. 24 million. So you can do the computation there. You can do the computation there. So income tax expense, just continue here. So we proceed. So, but I've been able to write there. So it is coming to 48 million. 48 million. Yes, 48 million. So what do you get as the part profit after tax? What do you get as the profit after tax? What is the part? What is the part? You get 100, 700. 100, it should be 100, 700. 100, 700. Then profit share from the associate profit, the part profit share from associate, profit share from associates. So the profit share from the associates, so it is 100, 700. Then you have the profit share from the associates. Remember the associate, you've actually been told that it had actually made a profit of how much? 30 million. So in this case, you're having just to take 40% of that. So 40% of the 30 million. So share of profit after tax of the associates. In this case, it is 40% multiplied by 30 million. So this comes to 12 million. I think it is 12 million. So it means in this case, our profits will likely be how much? 112,700. So the profits for the year, profits for the year, 112,700, 112,700. So this is the profits for the year for the entire group, the profits for the year for the entire group, the profits for the year for the entire group. But now there are those profits that in this case will likely end up having to be taken up by the non-controlling interest, the profits to be taken up by the non-controlling interest. So that is what I want us now in this case we compute. I don't know whether I think you are not able to see that far end. So we can adjust. It should be like that. So I want us now in this case we compute the profits that will likely be attributable to the non-controlling interest. The profits that will likely be attributable to the non-controlling interest. The non-controlling interest are those ones that in this case the holding company is not controlling. They are the minority. They are the minority. They are the minority. They are ones in this case that are not actually having to be controlled. So what was their portion of what? Of the profits. So the profits are attributable now in this case to what? To the non-controlling interest. Profits attributable to the non-controlling interest. Profits attributable to the non-controlling interest. So of course in this case you are told that H Limited acquired 80%. It means in this case our non-controlling interest is what? 20% is actually 20%. And if you look at the profits that were generated for the year for the in this case what? The subsidiary, it is 42 million. You can be able to see them in the income statement. You can be able to see them in the income statement. So it is 42 million. So of this 42 million, of course, like 80% was having to go to the holding company. But there's that portion of this that now in this case, the minority are having to enjoy the 20%, which the holding company is not having to do what? In this case, control. So in this case, we can do a computation here. So profits attributable to the non-controlling interest. So the profits attributable to the non-controlling interest. So that in this case, you can be able to apportion here and see which were the profits having to go to the NCI and which were the profits that actually ended up having to go to the holding company, to the holding company. So of course, you have now in this case, what are the profits for the year? Profits for the year. We have the profits for the year. So the profits for the year in this case generated, it was in this case how much? It was in this case how much? 42 million. That is what you can be able to see in the income statement of the subsidiary. It is 42 million. But of course, these are profits for the entire year. Remember, the holding company was actually acquired this subsidiary for only how many months? 9 months. So for only 9 months. And of course, you're having to consolidate the income statements for the 9 months. It means in this case, the profits for the year attributed to the non-controlling interest, you should be able to apportion. So it will be 42 million multiplied by 9 out of 12. So you'll be able to get, I think you'll be able to get a figure there. The profits for the year from the subsidiary, it is 42 million multiplied by 9 out of 12. I don't know what you're having to get there. So what do you get? 31,500. You get 31,500. But always in this case, what you have to consider, it is how are these profits actually affected during the post-acquisition period? How are these profits actually affected during the post-acquisition period? So for example, there's a computation we've actually been able to do regarding unrealized profits. Regarding what? Unrealized profits. Regarding unrealized profits. So that is under what? There's a working we've actually been able to do, whereby you are told sale from S Limited to H Limited in the post-acquisition period amounted to 30 million. S Limited reported a gross profit margin of 25% on these sales. So there's what you're calling what? The unrealized profit from what? From this particular what? Item. So less unrealized profit that was not actually realized. Less unrealized profits. So less unrealized profits under that particular working. So I think it was an amount of 1,500 because this one was during the post-acquisition period. Still the same case, there was depreciation under charge. So depreciation under charge. Depreciation under charge, which we got in this case 3 million. So we less it. Then of course, now in this case, we can be able to get the adjusted profits. Adjusted profits for the subsidiary. You can get the adjusted profits for the subsidiary. So this is 27 million. So this is 27 million. But now in this case, we are only having to consider 20% of this. So to the non-controlling interest, it means it will likely be in this case be what? 20% multiplied by 27 million. Remember, these are the adjusted profits for the what? For the subsidiary. But entire of these profits won't actually go to the holding company. So part of them will likely end up having to go to, in this case, what? The other non-controlling interest. Remember, the holding company is only controlling 80%. So NCI, the minority shareholders will also get a portion of these profits in the subsidiary. So they'll get 20% of it. So in this case, that actually comes to 5.4. So 5,400,000. 5,400,000. So it means when you're having to, in this case, apportion these profits for the group, so to the non-controlling interest, they'll likely be able to take a portion of 5,400,000. Then to the holding company, to the parent company, it means out of these profits, they'll be able to enjoy the difference, which now comes to how much? So 112,700 minus 5,400. Minus 5,400. So I adjust the camera. So you can copy this one. So this means these are the profits that will likely be attributable to the non-controlling interest. Out of the profits you've been able to get of 112,700. 112,700. So it means in this case, you need to less. To the non-controlling interest, it will be 5,400,000. The difference in this case will likely end up having to go to the parent company. It will go to the parent company. It will likely go to the parent company. It will likely go to the parent company. I think it is 107,300. 107,300. 107,300. It is 107,300. 107,300. It is 107,300. So that is what will likely end up having to go to the parent company. To the parent company. So take note in this case, when you're talking about the profits attributed to the NCI, so this is how you can be able to adjust them. So during the post-acquisition period, there can be happening of transactions that ended up having to affect the profits for the year for the subsidiary company. You have to make those adjustments there. You have to make those adjustments there before you end up having to, in this case, take a portion of those profits. Before you take a portion of those profits, which will go to the NCI, then the remaining portion, it means in this case, is what will likely be attributable to the parent company, to the parent company, to the parent company, to the parent company. So it means these profits of 5, these ones don't belong to the holding company. It's like in this case, having to say, assuming they distribute all the profits as dividends. It means if they distribute all the profits as dividends, the holders of 20% will get 5.4 million. The parent company will enjoy 107,300, assuming they distribute all the profits as dividends. So in this case, the minority shareholders in the subsidiary company will get 5.4 million out of the consolidated income statement what profits. While in this case, the parent company will get 107,300. 107,300. So that is how in this case you end up having to come up with what's the profits to the NCI and the profits to the parent company. The profits to the parent company. The profits to the parent company. So I want us now, in this case, we introduce another related area to group accounts, which I had already informed you we'll be able to look at, So it is known as group cash flow statements. So group cash flow statements. Cash flow statements. So of course, it's just a similar concept to what we learned under cash flow statements in published financial statements, only that this one has a bit more adjustments or a bit more workings compared to that other one. So that other one was actually, in this case, just a few computations. And of course, you can be able to prepare. So the format just remains the same with just a few additional adjustments in terms of what's the presentation. So most of those adjustments are having to relate to, for example, the associate, or maybe in this case, the subsidiary, or maybe the joint venture. So it means in this case, we just use the same format as how we prepare the cash flow statement for the published financial statements, only that in this case, we'll end up having to add a few more adjustments, a few more workings, a few more items when you're having to consider in this case operating activities, financing activities, and investing activities. But ideally, the concept is the same. It's just having to look at the actual inflows and actual outflows within the company. Then you do the necessary adjustments, in this case, to be able to know what are the items having to lead to actual outflow and actual inflow of cash within what the company or within the group now, within the group. So still, we end up having to deploy the indirect method and, of course, what direct method of cash flow statements. And the format is the same. So the three categories of the items in the cash flow still remains. Only that in this case, as I'm having to say, there are just a few additional workings that you'll end up having to undertake when you're having to present the cash flow statement for a group. So, and of course, you'll be able to look at them when in this case we do what? The computation. We do the computation. But the format will look like this. I would like you to get the format, first of all, before in this case, we'll end up having to proceed and look at the computation, which in this case will likely be in our subsequent class. So in this case, we have the indirect, under the indirect method. Under the indirect method, it will likely look like this. The cash flow statement will likely look like this. You can be able to get to copy it. You can actually be able to copy it. So you can say ABSA group, ABSA group, ABSA group. You can say ABSA group. Statement of cash flow, statement of cash flow, statement of cash flow for year ended. It can be 31st of December, XX, maybe a year there. So you'll start in this case with the operating cash flow from operating activities. So cash flow from operating activities. So operating activities, cash flows. Operating activities, cash flows. Operating activities, cash flows. You start with the operating activities, cash flows. Operating activities, cash flows. I can see Abdi is saying you need a break of 5 minutes. You need a break of 5 minutes. So you can have a break of 5 minutes. You can have a break of 5 minutes. Then when we come back, we can wind up. Yeah, I think we can proceed. So we can proceed. I think the 5-minute break is over. I can see Chris is saying even as Catholics are fasting. So it is 40 days to Easter, or how many days to Easter? How many days to Easter? Around 40. So you're also fasting. So in this case, we have we normally start with the profit before tax. You will start with the profit before tax. You'll start with the profit before tax. Profit before tax. Then you'll have adjustments for non-cash items. Adjustments, so non-cash items. You have adjustments for non-cash items. So in this case, we'll have depreciation. Depreciation is one of the items you'll end up having to adjust. So you add amortization or impairment, especially with the goodwill. So amortization or impairment regarding, for example, goodwill. That one you add also. It is an non-cash item that you have lessened in the income statement. Loss on disposal. Loss on disposal. So this one doesn't indicate real outflow of cash. So you also, in this case, add. Then finance costs. So you'll have to, in this case, consider finance cost. You'll add the finance cost there. Can have, in this case, the finance cost. So finance costs, and consider the finance cost. So finance cost will be there. Then in this case, we have gain on disposals. Gain on disposals, now you less. Gain on disposals, you less. Gain on disposals, you less. You can continue, just continue. So you can continue. This is amortization or impairment. Amortization or impairment. This is loss on disposal. This is finance cost. This is gain on disposal. Gain on disposals, you now in this case less, you less. Then you can continue, just continue with the same table. You'll say in this case associate profit. Remember, under group we do the associate profit. Associate profit or joint venture profit, or joint venture profit, or joint venture profit. So you also less. Then investment income. Investment income stroke dividends. So majorly there'll be items such as dividends. You also less. So you'll be able to get the final figure from adjustments for non-cash items. Then you'll consider the changes in working capital. Changes in working capital. You'll consider the changes in working capital. So increase or decrease in inventory. There can be increase or decrease in inventory. Increase or decrease in inventory. So increase, or let it just be like that. Increase or decrease in inventory. So if it is an increase, you likely end up having to less. If it is a decrease, you likely end up having to add. Then you can have increase or decrease in trade receivables. So in trade receivables, in receivables, increase or decrease. The treatment will be the same because they are all current assets. They are all current assets. So decrease or increase in payables. decrease or increase in payables. So then you likely end up having to, so you'll likely add in this case. And of course, if it is an increase, you likely end up having to less. You likely less like that. You likely less like that. So you'll get in this case the gross cash flows. Gross cash flows from operating. Gross cash flows from operating activities. From operating activities. Gross cash flows from operating activities. So that is the figure you'll be able to get there. Then you'll now in this case consider the tax that was actually paid. Tax paid, you'll less it here. So tax paid during the year, you'll likely less it there. So you'll get the net cash flows from net operating cash flows. You'll get the net operating cash flows, the net operating cash flows. So that is the figure you'll be able to get there, the net operating cash flows, the net operating cash flows. And of course, that is the first part that you would have completed. You would have completed the operating activities items. You will consider all these items for operating activities, so like that. So that is when you finally get the figure here, it will now be the net figure for these activities. Activities involving what? Operations in the business, operations in the business, operations in the business, operations in the business. So I can be able to see you asking about finance cost. So you can less the finance cost. So if it is there, I think you'll end up having to less. You can less the finance cost. You can less the finance cost. So because you can have tax paid, you can maybe include it there. You can include it there. So include it there, finance costs. You can less also the finance cost here. You can include it there. So in between there can be finance cost also. You can include it there. So then we can go now in this case to the, we can go to now in this case to the investing activities, cash flows. Investing activities, cash flows. Investing activities, cash flows. So we're gonna have cash proceeds from disposals, proceeds from disposals. From maybe you sold some items, some assets. So those were disposals. So they gave you some cash. So you consider that. Dividends or interest or investment income received. Dividends or interest or any other investments income. Any other investment income that was actually received. You likely end up having to add it there. Then disposal of subsidiary, net disposal of subsidiary. There was a disposal of a subsidiary. So you sold a subsidiary and you are paid. So that was a sale of an investment activity, an investment item. Acquisition of a subsidiary, you paid money to acquire a subsidiary, acquisition of a subsidiary. So now that is an outflow. It's like that what you're having to say, the purchase consideration. So you paid it. It means that was an outflow from the holding company. Purchase of non-current assets. Non-current assets, purchase of non-current assets. So you less it. So you'll be able to get net cash flows from investing activities, net cash flows from investing activities. Net cash flows from investing activities. So We put the figure there. So this becomes the second most important part of the cash flow statement. So that is like part B. That is like part B. Then we can go now in this case to the final one, which is financing activities. So financing activities. So financing activities cash flows. Financing activities cash flows. So we'll have in this case cash received from issue of shares. Maybe they sold some shares. So cash received from issue of shares. Then cash received from issue of debentures. Cash from issue of debentures, cash from debenture issues. Then loan borrowed, loan amount borrowed and actually received, loan paid, that is an outflow. So that when you deduct, is an outflow you deduct. Then lease payments, can in this case put lease payments. Lease payments, so you'll put it here. Lease payments, you can put it there. Lease payments, you can put it there. So you'll get the net cash flows from financing activities. You get the net cash flows from financing activities, net cash flows from financing activities. Net cash flows from financing activities. You get the net cash flows from financing activities. Net cash flows from financing activities. Net cash flows from financing activities. So now in this case, you'll add the three of them. So A, B, and C. You'll add the three of them, A, B, and C. You can add the three of them, A, B, and C. You get the cash and cash equivalents during the year. So the cash and cash equivalents. Cash and cash equivalents. So in this case, it will be A plus the figure for B plus C. You'll be able to get a figure like that. You'll be able to get a figure like that. Then you'll add the cash balance brought down. So add cash balance brought down at the start of the year. These are the start. Yeah, so hope you've been able to capture that. Hope you've been able to capture that. So the cash balance at the start of the year, you add on the cash and cash equivalents, which you've been able to add for the three parts. You should be able to get the cash balance at the end of the year. And of course, your cash flow statement should be able to balance. So if it hasn't balanced, then it means there'll be a problem. So the questions we are going to use for illustration. So there's a question we're going to use for illustration, which you'll be able to do on Thursdays. In this case, it is November 2018. November 2018, question number 3B. So this is the one we'll likely end up having to start with to look at. So you can just be able to look at the question, but that is what I'll be able to handle. So as I'd already indicated earlier, then we'll finish there. We'll finish a bit early today because of something I have to attend to a bit urgently. So you can look at this question, what it says, then I think we'll be able to cover it in our next class. That is on Thursday. That is on Thursday. So I don't know if there's any burning question you can be able to ask, but let me end there for now. So Monty says we lost me, but I hope the most important thing, have you been able to capture this? You need to tell me whether you've been able to capture this because I want to end the class. Have you been able to capture this? Then I've been able to say this is the illustration you'll be able to look at on Thursday. The second line on the last part, cash balance brought down. This one, cash balance brought down at the start. It is the cash balance brought down at the start. The cash balance brought down at the start. Cash balance brought down at the start. Cash balance brought down at the start. So that is the balance at the start. So cash balance. This is the balance at the start of the year. And this is the cash balance carried down. Cash balance carried down, C/D. This is the balance at the end of the year. The balance at the end of the year. This is the balance at the end of the year. The end of the year. So I think that is okay. So please post it immediately. So let me organize it to be posted immediately so that you can be able to catch up. You need to rewatch again. So that is okay. So let me organize it to be uploaded. Otherwise, thank you very much. So let's catch up on Thursday.